Hi, in this video, I'm going to deep dive into Lululemon's business. So, Lululemon is a full stack athleisure brand or apparel brand. And so, let's start with the business model and understand how they make money. So, the core business is basically to design, distribute, and retail technical athletic apparel. We'll get into this a little bit more during the future slides, next few slides. So, basically, they make um, performance clothing for when you're training or running or doing yoga, and also they've now diversified into other kind of occasions, which is lounge and social, some more casual clothing and so that's their core business. They basically sell clothing through either their own retail stores, physical retail stores, or the online store. And they got their start in the yoga category, they basically specifically in the women leggings, which is still one of their largest products, and that's what they are, very well known for. So they break down their business into geographical segments now. That's their primary way of breaking down business. Most of their business comes from Americas, which is US and Canada, and roughly 73 point or 74%. And then the second part is from China, mainland area and the surrounding area, and the rest of the world contributes roughly 13%. In terms of profitability, 75% of their operating income or the operating profit comes from the Americas and 15.9% from the China. So if you look at the ratios, you will see that their profit margins are pretty similar in the Americas and the China in terms of the ratio of the revenue and the operating profit coming from these areas. So their margins are pretty much similar, which is a good thing. In many of the other companies, you will see lower margins coming from Asia region, and then Lululemon has been able to kind of hold their margins wherever they open their stores. In rest of the world, their margins are a bit thinner, but I think that can be attributed to lower scale that they have in probably these areas. So they have higher fixed costs still because they're operating at a lower scale. And so hopefully as they scale up in the other areas, their margins will also improve. So they've said that wherever they go, they basically want to maintain a consistent kind of operating income profile or operating margin profile. The other way to kind of break down their business in terms of the channels that they sell, as I said, they sell through their company-owned stores. So they operate for 711 cell phone stores. Most of them are currently in the US. I think 369, 370 stores are in the US, and then others are spread out. And 41 stores are basically operated by third parties. So that's the total number of stores that are currently running physical stores. And together, these stores contribute roughly half of the revenue, 49% of the revenue. The other big chunk comes from e-commerce, and they have also have a small, I think, wholesale business. And they sell through other channels. Basically, that constitutes 10% of their revenue. So, company-owned stores and e-com are basically the major contributors. In terms of product segments, they are a unisex brand, so they market to both women and men, although they started specifically in women. As I said, one of their earliest products, and still I think their largest category is women leggings. So, women currently contribute 65% of the revenue, and men are at 23. And men is definitely faster growing. This is where they're still penetrating, quite quickly. And men is currently faster growing than women. But yeah, so that is roughly the split. And so men, women, and other here basically refers to their accessories business, which they break out separately. So this is where they make most of the revenue coming from America, US, Americas, and the China, and mostly coming from their own retail stores, and then that has implications for the business that we will see soon. So who owns this business in terms of inside ownership? So insider ownership, which is the executives that are running and the directors, the board of directors, combined, they own less than 1% of the business. Big chunks are actually owned by institutional investors, Fidelity, BlackRock, and Vanguard. The other big holder is the founder himself, Chip Wilson, who still owns, I think he's reduced his stake over time. I think basically he left the company around 2012, basically time frame when there was some controversy, but he still owns roughly 8% of the business, but he's not really actively contributing or not actively involved as far as the filings show. And the within the executives and directors, the largest chunks are owned by CEO and the chairman of the board. Both of them individually own, in dollar terms, more than 20 million worth of shares, and I'm not counting the stock options they own. This is just the shares of common stock that they own. So they own more than this, so that's why I said greater than 20 million, and I'm doing that at a price of roughly $250 a share. And the management is relatively stable. The CEO has been with the company for 6 years now. CFO has been with the company for 7.5 years. So the management is relatively stable. And this is just a snapshot of their cap table. And you can see that basically, these are the major holders: Fidelity and Chip Wilson and Vanguard and so on. And these are what other officers and directors own. How are they contributing? How are they basically compensating their management? So, like most companies, the most of the pay is basically performance based. So you can see the breakdown here: 8% base salary, 15% base salary for other neos, and for CEO, 92% is variable in terms of bonus. Performance stock units, which is basically if they achieve certain targets, in company performance, and then the other part is stock options, right? This is how basically I hope you know the difference between RSUs are basically time vested, PSU are performance vested, and stock options can be either of them. And then the bonus part is the cash bonus. So this is how the compensation is roughly split up. So what do they track? How do they basically reward their management? In simple terms, the targets are set on net revenue. There are revenue goals, and then there are operating income goals. And this operating income is basically adjusted operating income. And so if they basically meet their targets or don't meet their targets, their bonus amount can vary from 0 to 200%, based on if they hit their revenue and operating income targets. Um, and the way they calculated the adjusted operating income, revenue is, I think, simpler to understand, but the way they kind of break down operating income is they take their GAAP operating income, which, includes everything, and then they take out mostly one-time charges or write-downs that they have to do. So, for instance, they bought um, basically Mirror. They had an acquisition. They acquired a company called Mirror for 500 million, and then they had to do a bunch of impairments and write-downs because that did not work out. So they will basically take those GAAP results, and then they will adjust them for the restructuring costs if they are, laying off certain number of people, if there is asset impairment, stuff like that. So that's how they basically calculate their adjusted operating income. um, I would say that it's better than some of the other companies that I've seen that basically also take out the stock-based compensation, depreciation, amortization, which are just, as I said in previous videos, they are the worst kind of charges that the company has to pay. So their definition of adjusting operating income is basically taking out the non-recurring charges, which is still more reasonable. But I personally would say that, uh, impairment charges. I mean, I'm not so sure about the impairment charges, but at least one suggestion I have is they should include an efficiency ratio just in terms of the capital base they maintain and the revenue or the net income that they generate on top of that. So I think that would be helpful, and that will basically push the management to allocate the capital correctly. That's the only comment that I have there. So this is how they currently compensate their management. Let's understand the a few more numbers and ratios about their business. So they did in the trailing 12 months, they did roughly 10 billion, 9.8 billion worth of business. Their gross margins are at 58%. Their EBIT margins are at 23%. Their asset turnover ratio adjusted for cash. So basically, you take the asset base and you take out the cash and cash equivalents, and then see how much their revenue they generate over their asset base, which is 2.2, which is quite good. I would say for retail company, for a clothing company which owns the retail stores, and I'll talk about that in a moment. The revenue per employee is 258,000, which is not that high, but you have to remember that, I mean, in their proxy statement, they talk about their median employee is actually a part-time kind of educator, or basically a store assistant. And their median employee, in many other companies, which are basically for them, the main channel of selling is wholesale, and they don't own the stores, and they don't have to train those employees that work in that wholesale store. So if somebody's selling their equipment or their gear or apparel through Dick's Sporting Goods, like they don't employ the Dick's Sporting Goods people, right? But in case of Lululemon, they do. So their median employee basically earns roughly $19,000 is what they mentioned in their proxy statement, which may be different for other companies. But yeah, so you have to keep in mind that most of their employees are part-time, and so their compensation will be structured that way. So their revenue per employee is 258,000, which is not very bad, but others have better numbers. In terms of how they spend their money, and if you look at their P&L, it's not really that clear. They just kind of bundle below the gross margin line, they just bundle all the charges or all the expenses in a single line, which is selling general and administrative at G&A, which is 35%. And so they don't actually break it down how much do they spend on research and development and how much do they spend on sales and marketing specifically, and then in the general and administrative category. So they just lump it together. So it's not really at least that clear to me. But yeah, so it's not really clear how they spend stuff on their P&L line, but their SBC expenses are not that high. I mean, it's just 1% of the total revenue that they pay out as stock-based compensation. So it's definitely not that high. Pretty, reasonable. And so let's look at how does Lululemon compare to some of their peers, just in terms of these ratios, and is their business, does their business really stand out on some of the things? So if you look at the gross margin line, they make, so we doing Lululemon, Nike, Adidas, Gap, and Deckers. And so if you look at the gross margin line, I think you can clearly see they have one of the best kind of gross margins in the industry, and we'll talk a little bit more about why that is in a moment. But they have one of the best gross margins in among their peers. Their EBIT margins are also superior compared to most of their peers. Their asset turnover ratios are also superior more compared to most of their peers. And the revenue per employee is not that good. But again, I said most of their employees are part time. So if you discount for that, I would say they would come out at least comparable to everyone else. Deckers definitely stands out. But so that's how I would say generally I will call it an efficient business, and I think they do in their numbers show some differentiation from among their peers. One other kind of way to look at Lululemon, how their business is different. I think I started the video by saying they're a full stack athleisure brand or apparel brand. So what does full stack mean is they basically own the whole journey, right? So they own their retail stores, or at least they have leased it for the long term, many of their retail locations, and they own or have leased their distribution centers, right, through which they run their e-com business and also supply their retail locations, and manage their inventory. So if you look at the property, and equipment, plant property and equipment line on their balance sheet, and you compare it to the size of the total asset base, you will see it's quite different from other apparel retailers who basically whose main channel of selling is through wholesale, right? So they sell through other kind of retail locations that are owned by other companies, or through independent kind of retail locations, right? And so they have their wholesales and distributors. In the case of Lululemon, they own most of their retail and kind of distribution locations. So their property equipment is quite high, 41%, 20%, 24% for Adidas, and 52% for Gap and 16% for Decker. So Gap also owns, or at least leases many of their stores. So they have, like company exclusive stores through which they sell. And you can see that if you kind of look at that and you look at back at the asset turnover, and kind of the revenue per employee, for running your own stores and selling the apparel, you can see that, it's actually comparable to Gap, and they're quite premium both in terms of, like, they kind of beat the asset turnover, their efficiency ratio, quite well. So for a company that owns or leases, long-term leases all of this stuff and has that sitting on their balance sheet to have good efficiency ratios, they definitely, I would say, stand out from their peer group. um, and so yeah, so that's about the peer comparison. So let's take a moment to just understand the retail value chain. I think that will basically help with the next few slides. So what does full stack mean? So if you kind of break down the processes and the stages of kind of building the apparel and then selling it, you can basically break it down into four. And then one global function, which is marketing, right? Which we will keep separate for now. So the four stages of actually delivering is designing the apparel, manufacturing it, then distributing it, and then retailing, right? For most people, for most other kind of apparel retailers or brands, they would do the design part, they would outsource the manufacturing part, they will then use distributors who obviously will have, they're running their own business, they want their own margins, etc. And so therefore you see for many other kind of apparel retailers, the gross margins are lower because the middleman or the wholesalers are eating a section of that margin, and the end, retailers also eating a section of that margin, a portion of that margin. But for Lululemon, they basically own 1, 3, and 4. So they design their apparel, they distribute it, they manage the distribution, they manage the inventories, and then they retail it, right? So what happens in each of these stages? In the design stage, you would basically have do the prototyping of your end product, or you will kind of conceptualize that. There is fabric research involved, I think, in terms of what kind of material can be used, the design, colors, based on the customer feedback or data that they have seen, what kind of things that do they like, and basically then testing on some of with some of their educators or some of their kind of internal testing team, right? Kind of what's called as red teaming, testing internally if the product works. The second part, basically, Lululemon outsources, which is manufacturing. Most of the manufacturing happens in Taiwan, China, Vietnam, like these regions. So in this part, the main job would be to kind of source the material. Once you kind of know what material, then you need to source the material at scale. You need labor, you need manufacturing equipment, you need to optimize for scale. So this most of this they outsource. I'm sure they're involved with sourcing, and then they are definitely involved with making sure that their labor practices are being followed up to their standards. The wastage is reduced. There's low wastage, and the environmental regulations are being followed, so on and so forth. So I'm sure they are basically involved in all of that, but the work is actually done by third parties who manufacture and then ship it back to Lulu. And then in the distribution part, where you have to actually, receive those things and kind of distribute it out to all your, send it out to your distribution centers, transport them, manage the logistics, store them, and then, make sure that the right assortments available at the right location, so on and so forth, right? So all of that is being done. The distribution is being handled by Lulu, and the retail locations, which I think is most value accretive. Like, this is where you interface with the customer. There are a lot of things that you can do on a retail interface. At this level, a lot of kind of decisions are being made, including how the products are being played, how are displayed, and how are they being placed within the store. How's the store being designed? How's the pricing being kind of decided? Does some of the inventory need to be discounted so that more inventory can come in? The pricing is being decided. The customer data is being captured in terms of the whole customer experience or their sign up or loyalty programs and so on. If there's a problem with the product, there is after sales service, there is support, and there is education. And then there is staff management, staff training, so that they can educate the incoming customer. So I think most or a lot of the value in the process definitely, and is being created at the retail stage, and all this data that you collect at the retail stage can be fed back into the design phase. you know um, and so I think so this is how you should kind of understand the retail value chain. Obviously all of these steps are quite important in different ways, but yeah, so I think a lot of value is kind of concentrated in the retail portion of this value chain. And so where do I see, that this business is kind of differentiated? Why do I think they kind of edge, and what things can they execute against? So, they have among in their physical footprint, they have one of the highest kind of sales productivity at roughly $1,600 per square foot of the retail locations that they own. And so that just, I think, speaks to their pricing power and kind of the experience within their store, and what people are ready to pay for the quality of the products that they're building, right? And so that shows that their business has their products kind of stand apart. And the second part is they have full control over the customer experience from the time a customer comes in. As I said, education, servicing, and all of those kind of different touch points with the customer, they can own them. They can capture the customer data. They can know what the customer is interested in. They can position the right products to them, so on and so forth. And I think building a full stack experience is hard, because if at some point, at the design, at the manufacturing stage, at least you see that to achieve good unit economics, like to make Apple at a reasonable price, you need scale, right? And so that's how you bring the unit cost down, and that's how you can sell it to the end customer at a reasonable price. And to achieve scale, you basically first need to have that scale through your own reach. So it's basically a chicken and egg problem, right? I mean, if you need scale, generally you will go through the distributors because then they will give you the scale. They will place your products in many different locations. One, if you don't have a physical footprint yet, right? And you don't have you're not selling, you're not able to sell at scale through your own channels, you will go through the distribution channel, right? So what Lululemon has done, I think they've solved basically both parts of the equation where they have achieved enough scale to sell this through their own channels, and now they are basically able to capture all of the data. Recently, if you know, Nike has tried to shift it purely to the D2C model, and they couldn't shift it. And Nike is the biggest brand, like that's the biggest name is this in this game. So and they had a hard time kind of shifting completely to D2C. Now they're coming back to the wholesalers to kind of win back those placements within their retail stores. So it's definitely a hard thing to do, to solve for the scale on the retail side, and then kind of, so that you can have the right price on the manufacturing side and so on. So that's, I think, a hard thing to build. And so again, I think the data captured from the returns and purchases of the customer and the feedback that they give, that can be much more. Yeah, like you can basically monitor the traffic in your stores. You can see what they're purchasing. You can see what they're returning, what products are they interacting with more, and so on and so forth. So that data can be much more easily fed back into the design phase for faster feedback and product iterations. And Also, because you are basically capturing the data across different touch points, you are able to kind of show the right product to the customer. If they bought, leggings from you, then you can show them leggings that are similar color, or leggings that are, for heavier workouts, or a top that goes with it. So you can basically help them mix and match, right? Because you know a part of their wardrobe, like you know what they've already bought, and then you can basically show them other products. If you are selling through a wholesale channel, for instance, because that data is sitting with someone else, it may be harder to, kind of get back into the pipe and then personalize the customer experience. And also, you don't, control the customer experience. They have a fair bit of experience with the fabric innovation. I think Lulu basically spares kind of, they were the pioneers of the athleisure trend. So they have a good experience, like a reasonable amount of experience in the fabric innovation in terms of the stretch, the comfort, the sweat wicking, the odor, non-pilling, kind of designing those fabrics, researching that, and sourcing those fabrics at scale, so on and so forth, right? So which they call their science of feel platform. So they have a lot of experience kind of designing those kind of fabrics that customers love, that are a good fit, that feel great during the day, that are more functional in many different ways. And from what I've read, Lulu's basically gear, their apparel lasts a long time, and generally people love them. At least, from a few years ago. Recently, I've heard that the quality has suffered, which is something that can be that can improve over time. But from what I've heard, people who buy Lulu, they're like loyal Lulu customers, like they're loyal Lulu fans. Uh, and One of the other trends that I see, which is basically an opportunity for Lulu, is I think there is basically a shift away from fast fashion due to ecological concerns, environmental concerns, the waste that it produces to just buy cheap clothing and throw it in a dump. I think the basically trend is shifting now more towards looking at clothing which can last longer, which can keep you more comfortable, and which can be treated more as of an investment rather than a spend. So if your clothing is going to last you several years, I think people may be a little bit more willing to pay that premium, because they know they're going to use that over time. And they still have a long runway for growth. I think their numbers in terms of their global unaided brand awareness that they talk a lot about. I think that it's still growing. It's still low in many of the key markets, including China, and in US. It's also, I think, in 30-40% or something like that. I think Nike is 80% plus. So their brand is not that well known. So they still have room to grow in a lot of their markets, and some of their markets have not exploded at all at this point. So, so these are the opportunities that I think they can execute against. Moving on to the risks that I see in this business. Firstly, obviously, apparel industry is highly competitive. There are many new brands that have come up, Alo Yoga and Vori, and so on and so forth, right? So it's not that hard to kind of launch an apparel brand. It's highly competitive. People can kind of enter from the bottom and they can start eating your market share. And at this point, although they have differentiated fabrics, they have definitely a larger brand some than some of their probably new entrants. But it's not clear that their fabric IP, their technology IP, and the clothes that they're kind of building and selling, will they be able to kind of protect them from this competitive onslaught? And also, they will see the competitive pressures from Nike, Adidas, like players who are bigger than them. They will try to kind of innovate in this direction. Although Nike is mostly footwear, like that's where most of the money comes from. There is, so this is some Lulu has something that they've recently faced in recent quarters, basically wrong assortment choices in terms of sizes, colors. Like if you make the wrong choices and you end up with the wrong inventory, like you just build the wrong inventory, that can basically build up your inventory, right? And then you need to discount it and get it over with, and that will hurt your gross margin. So if you kind of misjudge what people want or don't deliver the right sizes, right colors that they want for the season, that they want for the year or semester or whatever, then you can end up in a bad place. Your profitability could get hurt. So if you don't interpret that demand correctly, and so that can basically hurt this business and end up with the wrong assortment choices. So most of the raw materials is sourced from, as I said, Taiwan, China, Vietnam, from the Asia Pacific region, which quickly, can have some supply chain risks if there is a problem within that area in terms of geopolitical tensions. They may get hurt. I think the largest company that sources them fabrics is from Taiwan, Eclat. And if there are economic pressures, like people don't want to spend on high kind of price clothing or premium clothing, then they may also suffer because they are definitely a premium brand. And if people shift to lower price alternatives, newer brands that offer these things at lower prices, they can also kind of put them under pressure. So these are some of the issues, or things to watch out for in this business. And if they make any bad acquisitions, I think I already talked about the Mira acquisition did not work out, cost the company $500 million. And so if they, do these kind of acquisitions that don't work out in the future, some of that stockholder capital that can just, go to waste. And so if there are larger acquisitions, that is, I think, risk with many companies that are acquisitive. But Lulu is not essentially very acquisitive. Like this is an acquisition that they made, I think, after the pandemic when there's a home workout trend, but they're not necessarily going out and doing a lot of large acquisitions. That's not in the in the growth playbook. Um, in terms of valuation, it currently trades around 260, which is EV to sales of roughly 3.3, with an EBIT margin of 23%, which has room to grow because the gross margin is 58%. So as they kind of optimize their operating income lines, of which there are not many, as I said before. There is definitely room of growing that operating margin. There's also room of growing the top line. They're currently at $10 billion revenue roughly. So I think at these valuations, to me, it looks a good risk reward bet, given the positioning of the business and so on. And that's about it. Thanks a lot for watching. And do let me know if you found the video helpful. That is, it helps to keep me motivated. Thanks a lot.